They all track the S&P 500, but they don't exactly trade in the same way. So you've probably seen them everywhere on your charting, on your trading platforms, but which one should you be trading? And what are the differences between them? So today in this video I'll break down exactly what you need to know, which one you should be trading, the advantages, the disadvantages of each, and which one could work for your strategy. So we start off with the general S&P 500. What is it? So it's actually known as the index for the top US 500 companies. So it's a sort of benchmark. It's not a stock and it's not a fund. All it does is it tracks the performance of the top 500 largest US companies. We have a look at the actual components of the S&P 500, Nvidia, Microsoft, Apple, Amazon. These are the 4 biggest American companies in the S&P 500, and they actually contain the largest amount of weight within the index. There's also another thing called the Mag 7, which are the 7 tech stocks. And as you can see, the 7 tech stocks contain the majority, the heaviest weighting within the S&P 500, which is why the technology sector is the most important, and it is the sector that moves the markets up and down. So now we go into SPY. What is the SPY? So SPY is the ETF version of the S&P 500. So it essentially tracks the S&P 500, the index, 1-to-1. So it's great for equity traders and swinging positions over a long duration. And it trades like a stock, and it's very popular with investors as well. People that want to hold positions for a very long time. You can buy and sell on any broker. Brokers are very flexible when purchasing SPY or selling SPY. It's also super liquid, which is very important. Liquidity is a key component if you want to be a trader. You have to understand how liquidity works. Tight spreads, again, the difference between the bid and the ask is very small. Long-term, swinging, option trading, SPY can suit your style in a variety of different ways. And of course, it's very simple to gain exposure to S&P 500, like I said. A lot of brokers do offer it. So SPY is sort of the simplest ticker that you can trade of the S&P 500 index. Okay, now we go into the SPX. What's the SPX? So SPX, once again, just like the SPY, represents the S&P 500 index. So it's mainly used in the options market. And these option contracts are cash settled. So now I just want to show you this, the option chain. If you trade SPX, you have to be familiar with how the option chain works. This is essentially how SPX trades. On the left-hand side, you have the calls, and on the right-hand side, you have the puts. If you're long a call, essentially you want the price to go up. If you're long a put, you essentially want the price to go down. This image here I took from my Interactive Brokers account, and it shows quite nicely here the different premiums that are associated with the strike price. So more on SPX, it offers huge contract sizes, and that's just understanding how options actually work, the fundamentals of option contracts. Tax advantages for US traders. So this will be regards to the 60-40 treatment that is for capital gains. But on the flip side, SPX is more complex and it's more for experienced traders. It's less liquid for small traders, and the option premiums, depending on when you're trading during certain weeks, can be very expensive. Also, depending on geopolitical events, that's also a key factor because the volatility is a key component in how the options are priced. So if you're managing size or doing structured option trades or complex option trades, SPX does make sense for this. Otherwise, SPY options are probably a better entry point for people trying to get into the options game. So now we go into the ES. The ES is the E-mini S&P 500 futures. So without going into the futures market too deeply, just know it's very highly leveraged and it requires margin up front, which is why sort of beginner traders stay clear from the ES at the beginning stages of their trading journey. So the ES is very heavily traded, very, very liquid. On all brokers, there's a very fast execution time and there's very tight spreads between the bid and the ask. Like I said, it's for experienced traders mainly. High volatility, and it's great for day traders and scalpers due to the fact that you can control a large notional position with a relatively small margin deposit. And finally, we have the US500, also known as SPX 500 or sometimes even SP 500, depending on your broker. So these are CFDs. Now, CFDs stand for Contract for Difference. So once again, they mimic the S&P 500 index, but they're mainly used for people outside of the US where access to sort of US exchanges, futures or ETFs are sort of limited. They're actually banned in the US for retail traders. They're unregulated, high risk, and there's no centralized exchange. So you will see them on a range of different platforms. But one good thing to mention about CFDs are that they do offer low barriers to entry. They are flexible in sizing and sometimes even zero commission, which makes them quite popular outside the US. But they do come with huge risks. Due to the way CFDs work, there are sometimes very wide spreads depending on your broker. There's also overnight swap fees, which aren't ideal if you're trying to swing positions over a long duration. There's a broker risk. Some brokers overseas unfortunately go bankrupt, and it means you can lose all your money in your account. It's not ideal for large, long-term trading, like I said, due to the swap fees. And also, like I said, the limitation, if you're in the US, you can't trade it. So now if we combine all four of them together and we look at sort of the liquidity aspect of it, because liquidity is a huge topic in trading and it's one of the most important topics in trading. The ES and SPY are very liquid, which is a huge positive. Now, due to the ES being able to trade overnight and pre-market, the ES leads in the liquidity factor in those time zones. During market hours, this is where both the ES and SPY are traded the most heavily. And then of course, after hours, when SPY shuts, ES is then traded once again. So you need to understand that in the liquidity sense, the ES and the SPY are both very heavily traded. Now let's go into some key differences, like I was saying before with the ES futures. Due to how futures are constructed, it's naturally leveraged, which means you can get $250,000 of exposure with only a $10,000 account. Now, a lot of people might think this is a very good thing, but it's actually very risky for beginner traders, hence why I say beginner traders should stay clear of ES futures. ES traders also get the 60-40 treatment that I was mentioning before with regards to the taxes. SPX options give high leverage due to how options are structured, but no shares. And the US500, once again, high leverage depending on your broker. Some are 1 to 250, some are 1 to 500, some are even 1 to 1000, and only a small amount of capital is needed. Now let's look at when to actually trade each of the tickers. So if you're scalping or day trading, the recommendation is that ES, due to its high liquidity, like I was mentioning before. If you're swing trading, it makes sense to trade the SPY. The SPX only trades options, and the most traded options are actually 0 day to expiration options. And with ES, of course, you have the margin risk. In terms of trading around economic events, it makes sense for you to select the ES. If you're trading outside of the US, you have the US500, the CFD option. And if you want exposure to options, you have two options here. Those will make sense if you want to go through the option route.